Hello, I'm George Abernathy. I'm the proud president of FreightWaves. Welcome to Supply Chain Spotlight. Today, from the Greenbriar Equity Group, we have John Anderson, one of their managing partners. John, thanks for doing this today. I really appreciate you spending time with us.
George, I really look forward to it. I watch these regularly, the ones you've recorded before, and feel very good to be asked to be on it. So thank you for doing that.
No, I appreciate it. It's going to be great for everybody who's viewing us. Let me do a little bit of background on John. There's a lot of background, so I'm going to try to keep this concise so that we can spend more time on some of the things that John has to tell us. Prior to joining Greenbriar, John was the managing director with Fenway Partners, where he founded and co-led the transportation and logistics investment practice. Before joining Fenway, John was executive VP with two different railroads, the BNSF and CSX Transportation, and he was also a partner with McKinsey & Company. So we've got somebody who I consider a personal friend. Want to make sure we let that be out there so that if there's a little bit of inside baseball between John and I, we'll try to keep that to a minimum. So John, let's have at it a little bit. So obviously, in the world that we live in with the pandemic, that's going to be a lead question. What are you seeing now as we're moving our way through the fourth quarter? Where are you seeing the market now with regards to opportunities for Greenbriar? How's the overall market starting to work its way along?
Sure. Well, let's step back just briefly to February, March. The pandemic hit pretty surprisingly quickly for everyone, and every industry and every individual was affected in their own ways. Greenbriar, we all went home. We closed the office and had everyone work from home, and that went well and is going pretty well. The deal market pretty much stopped. I think, like a lot of other firms, we had some deals. I think we had a couple of good deals in the pipeline that were ready to go, moving forward to completion. They really got put on hold. Nonetheless, we did close one 3 or 4 months later. The deal market in general, though, really slowed down. A lot of it was uncertainty in two ways. How are we going to get a deal done, do the due diligence and so forth, and also how are companies going to perform? Nobody wants to be the goat who paid top dollar for a company coming off of a great year last year, and then they go out of business because of the pandemic. So everything stopped for that, George. Moved on through the summer. There really was a pickup. I think for businesses other than those that maybe were in hospitality or airlines or so forth, my impression from looking at our companies and my peers that I talk with, most businesses did better than people would have expected. March, April, we could see, half the private equity companies being in big trouble and so forth. Really not the case at all. And due to a couple factors. One was management teams able to really quickly restructure, cut costs, find new ways to do business, jump onto new elements of business that were actually pro-pandemic, supplying medical supplies, that kind of thing. And then the second factor that I think made it better was demand just didn't go down at least in the businesses that we're involved with as much as we ever thought. Now we're coming into the fourth quarter. The market has really picked up. I'd say in the last month or so, market increase in deals that we're seeing available to buy, interest from potential buyers in companies that we have that are ripe, and just all of the ancillary factors that help make deals work, the financing markets, the ability to do some due diligence, to do some in-person meetings, things like that. So it's picked up a lot for being less than a year from when the pandemic really started. And the deal market is much more robust than I think most people believe, certainly than I believe.
That's very good news. And let's talk about, with that now opportunistic amount of potential portfolio companies out there, how has doing the due diligence changed? I mean, I know John Anderson as the consummate road warrior who gets to know the inside of the business. I mean, literally gets to know the nits and gnats and inside of the business, as well as the management team so importantly. How do you see that? How has that changed to how you're doing it right now, and how do you think it will evolve downstream to be the way that due diligence will happen going forward?
Sure, that's a good question. I think we're still learning, but we've just learned a lot. We being, let's say, private equity professionals, I think. Um, Obviously, there was almost no ability to do face-to-face meetings until maybe a month or two ago. Everybody was just locked down too tightly, and people just weren't comfortable doing it. That has moved now so that we find almost all sellers, bankers are willing to have face-to-face meetings now. We're careful about them. We don't do them as casually or as frequently as we did before. So I think, as you can imagine, all of the market work, the analysis on market size and demand patterns and history, all of the financial evaluation and analysis of a company, that has proceeded long fine. So that's a big part of our due diligence anyway. I would say we couldn't close a deal without having some face-to-face meetings with management, and probably without seeing some facilities. So the couple of deals that we have closed, we have in all cases had face-to-face meetings. So we couldn't do it without that. So the fact that that started up, that's been a big boost to the number of deals and the probability of getting them done. I do think that two lessons we've learned. One is in terms of time with management, that, believe it or not, and you're right, I've always been a very much of a kind of face-to-face, get to know, build the trust type of person, eyeball to eyeball, breaking some bread together. I think we're seeing more and more that that's probably still a real plus and maybe something that has to be done. But we are asking ourselves what really makes the difference with a management team. And you and I work together in kind of a management private equity role for the track record of the individual managers and the track record of the team is really the absolute gold standard evaluation tool. A 4-hour dinner with someone or a 4-hour interview to ask them, are you smart? Are you good? Do you know how to do your job? You can learn more about asking a half a dozen people who worked with someone, how has this person or how has this team done over the last 10 years? And tell me about that and let's see the proof. So I think we've come to realize we ought to rely more on that kind of thinking and due diligence and analysis than how does somebody give dinner. A lot of people give good phone or give good dinner. But anyway, that's something that we've learned. I think a second thing we've learned is that you can be much more, you can substitute the Zoom, the Teams for half of what you used to do in person. So that's how it's evolving, George. And to be honest, though, you and I were talking before we started here. The real question is going to be once all the restrictions are lifted, you can travel as much as you want, you can have dinner wherever you want. So what will we do? Will we go back to the old way where it's mostly travel, be in person, takes a day or two of your time? Or will we do much, much more in Zoom? And that's to be seen.
Yeah, I definitely agree. Well, as one who has made a career on doing good dinner, I appreciate you saying that that's an important part. So let me
do good dinner also. I will confirm that.
I appreciate that. So let's think about the companies that are out there that are sort of on the other side of the table and trying to get noticed. They're how does a company get on John Anderson's radar? How does a company get on Greenbrier's radar?
I guess generically, you could say that we're buying kind of 3 or 4 different ways. The standard, probably the most common way is a company hires an investment banker to sell them. And that's our channel. We get a call from an investment banker. We always try to get that to be, well, we'll give us an early look, and if we want it and buy it and give you a good price, let us do it without competition, without an auction, without a process. but sometimes they go to auction and process. So that's a very common way we hear about things. Second would be that we have personal relationships we've built up over time, and frankly, it's a big part of my job. For example, is to use I have 40 years of experience and relationship building now to just always have a lot of people that I'm staying in touch with, understanding their business, helping them. And when they want to sell, they think, well, let's see, I could hire an investment banker, go through a process, or let me just see what John thinks about this, and get a call that way. So that's the kind of direct proprietary way to get a buying process started. A third way is that it's a public company, and we may want to take a public company private, or we may want to work with a public company that we know. It's one of the reasons I stay in close touch with a lot of public company CEOs when they want to take a division and spin it off. So I've had a recent situation where a European company has a division that is in logistics. It's not, it does the parent company's logistics, but they don't really want to keep running it. It has all its challenges, takes a lot of time. So they're thinking of spinning that off. And they don't want to be too public about it. So that's where they'll call and let's say, hey, let's talk about it. And if we can do a deal straight up, that would work. So those haven't changed because of the pandemic, and they're now all heating back up again.
It's really interesting. So, as so many things have changed during the pandemic, do you see partners like you, like Greenbrier, is there any change to the way that you see how you'll be interacting with those teams like you and I did? Will there be an evolution to that because of what the pandemic has challenged us with?
Sure, that's a good question, George. Naturally, through the pandemic and over the last 8-9 months, things have changed. We've done no in-person meetings, and you can remember, depending on the cycle of where you are as a private equity firm in a company you own, you might be on site every week for a day or two. If you remember, that was kind of what you and I worked together early on. Then you get on the same wavelength, you get more confidence that you have a really shared vision going forward, and that backs off some. You don't do that as much. So we've done 0 in-person meetings and travel over the last months. Then a month or 2 ago, as things loosened up, depending on the situation, then we would start meeting again in person. We're just now starting to get together for at least board meetings and maybe a meeting or a dinner with a management team now and then. So I think it follows the pattern of most things, whether it's buying a company, whether it's meeting with an investment bank, getting ready for us to sell a company, whether it's interacting with the management team. The pandemic has overridden every other instinct and situation, and so I think I expect that to evolve back to something more like it was before. We're kind of dancing around to some extent, George. I think a question of what long-term effects will the pandemic have on private equity firms and private equity relationships broadly. And obviously none of us know, and I think it depends on the speed of both medical and vaccination answers to this. I have a view that the combination of medical treatment, vaccines, and kind of psychological comfort, and I guess this presupposes I also have an assumption about what I think, COVID really is in the long run. I think we'll get back to more like pre-pandemic than not, if you ask my opinion, that the pandemic will ultimately be treated like something we do have to live with, and we'll be thoughtful and careful. But I'm expecting enough protections that it won't be a heavy weight factor. I think back to what's another example? 911. Tremendous issues and effect on us when we were going through it. And if we look back now, we're more careful and there's more, but long TSA lines are kind of the only effect that lasted 20 years. with the pandemic, I kind of think it'll be the same. I don't know which effects will last, but that's my thinking, George, is this is not going to change our life permanently and not change the way we do mergers and acquisitions.
So let's think about that. I think you're right. We are all trying to figure out what are the long-term impacts. As we've looked at the transportation, logistics, and supply chains, a lot of what you hear, John, is that we've pulled like 2 years to 10 years worth of actions or activities. We've pulled 2 years of e-commerce expectations for what we expected to be happening in e-commerce in 2022 or 2023 are happening today, or some even are talking about it being further and being in 2020 or 2021. Let's stay in the area of M&A and your bailiwick. Do you see that deals that have gotten, I don't know, delayed, but we're starting to crank the flywheel again? Do you expect 2021, 2022 to sort of be the opposite? We're going to have pushed deals, and with a fair amount of, and tell me if I'm wrong, a fair amount of money available, money waiting to be deployed, that 2021 and 2022 could just be banner years in the world of private equity?
I think that is a good insight, and I think that's a pretty good assumption, George. And I'll tell you why. Well, let me start by saying, what has the pandemic done to the types of demand and where profits are made in transportation logistics, which means that's where we look a lot of times more. And I think you picked out probably the one area, which is e-commerce, that the pandemic has made phenomenal on the upside. Travel and leisure will be the analog on the downside, I think, for a while. So yes, you stated exactly right. We accelerated e-commerce, the trial for people who weren't used to it, the comfort with doing kind of everything by e-commerce has been terrific. And we own a last mile parcel delivery company, LaserShip, which works in the Northeast, delivers mostly parcels, packages to the homes for retailers and for Amazon and for others, and just tremendous increase in their business. And I think that's close to permanent. So that factor from the pandemic will mean future deals the volume of deals in that space will be much increased. There'll be more focus on it. They'll probably be more expensive. And there's been a proof coming through the pandemic that e-commerce is real. You can make money at it and so forth. The notion of the leisure and travel, it's going to be just the opposite, that they'll just take time to come back, and so that'll slow down for those. If we step back now and think about the overall level of M&A activity, as you said, kind of really down in 2020, it's going to be, even though it's coming back, it's going to be really depressed. Yes, there is definitely makeup to do. And here's two factors to be the case. One, as you know, private equity controls a nice sized chunk of business. Let's just stick to North America, a nice sized chunk of business. And if that's, I don't know what it is really, but let's say it's 10%. A lot of us have held companies the normal amount of time we hold them, and we're ready to exit. And so given that you've put a plug in the drain out of the private equity tub, when that plug comes out, which is just kind of starting and will really come out when there's a vaccine, when there's better treatment, and when everybody's willing to bet on, gee, we're coming back to kind of normal economic times. When that plug comes out, there will be a bit of a rush for exits. So there'll be more than normal, I think, for sure. Secondly, private equity, my impression, and certainly for Greenbrier, has been more resilient than we would have thought in terms of our portfolio companies doing well. Our investors who invest in the private equity funds that we raise have been, I think, pleased with the performance, surprisingly pleased, and are willing to keep contributing money to us. They want to keep their returns flowing, so that capital is still available. And it's flowing into new funds. We are in the middle of raising a fund right now. We'll have our first close soon. And so there is going to be more than average capital next year, let's say. So if you layer on a vaccine, psychological confidence people have in cutting the deaths because of good treatment, so the pandemic seems less, what's the word, less serious, um, then everybody's back to work. So I think you characterize it right. It's like pulling the cork out of the drain of capital and private equity firms needing to exit companies. So 21, 22 could be banner years. If you layer on top of that the fact that performance in the companies in many, if not most portfolios has been pretty darn good. Maybe not boom year good. Pandemic has had an effect, but between cutting costs and between really managing capital, working capital and cash flow well, there's kind of almost eye-popping good performance coming out of a lot of private equity owned companies. They're going to be attractive to buy.
That's really interesting. So Supply Chain Spotlight, one of the things that I love about this series is we do, have a spotlight on somebody who's, got such a, remarkable reputation. And it's great for people like you to be able to speak to, the next generation after you and I, and you talk about your Rolodex. I mean, if you haven't left me your Rolodex in your will, please do so. I would just ask for that. Everything else can be dispensed everywhere else. But as you think about your next couple of years, I mean, you're a guy that was putting hundreds of thousands of miles in airplanes, and I'm sure that American Airlines and Delta Airlines are waiting for you to get back to where you were, and the likelihood is that's not going to take place. What was the biggest year, the most significant year of travel for you in the past? How many days out of the year would you have been away from home?
Sure. Well, that's a good question, George. I'm sure it probably matches about your record too, because we both kind of work the same way. I think I still think of travel as just a part of my job. A lot of people ask me, "Do you like to travel? Does it get to you to bother you?" I say, well, I like what travel allows me to do, and I like the result of travel, and I don't mind travel. Nobody likes going and standing in a line in an airport. Nobody likes pouring rain when you can't get a taxi and you got to go to a dinner and you're late and all that kind of stuff. But I do like the adrenaline rush of getting out in front of a company we might buy and so forth. And I continue to, even though I'm heading towards 70 next year. I will do that. So kind of wondering, back to your question, I suppose in an average year, especially since I've been in private equity, George, it probably about 20 years, which I think was more than when I was running railroads or at McKinsey even. I would say on average I've traveled 40 plus weeks a year, at least 3 or 4 days in those weeks. And so that gets you up to 75% of every work week in a year. I'm on the road probably. I anticipate, George, by the way, that will get back approximately to that level. And I think it's coming. And you pick up things on the road if you're observant or with people. Back to our discussion about Zoom versus travel, that you really don't on a Zoom call. And so I anticipate doing that. One other twist on what you said, though, is as we age, as we maybe not even physically or mentally change a lot in our aging, if we're lucky, but as we age, our peers are retiring. So you have from kind of your peers and that side, things are changing, and I won't be as effective now, or certainly 5 years from now, as I was 10 years ago. And second, younger people in Greenbrier, for example, are coming up. They've got that energy. They've got peers and contacts that they're doing, and I can pass on some Rolodex contacts, as you said, but I owe it to them to get out of the way so I'm not blocking. And secondly, to kind of shepherd them along so they can add the value that they're capable of doing. So that's part of my plan right now. Is I don't expect to be doing this 10 years from now. 5 years from now, maybe I'm doing this half time or something. And so I keep working with my partners, and we all keep kind of figuring out what's the best role for each of us to do. And it's a fun part of private equity. There's just a lot of flexibility.
You've had a wonderful career. Let's stay in the private equity part. Is there a particular deal or two that, obviously, delivering your investor and shareholder value is important, but any particular deal that strikes John Anderson as especially, I knew that one and people didn't believe in it, but it ended up being a success? Are there any of those that are just, the ones that just make you feel good as you look back on them?
I don't at all mean to flatter you, but I will call out my two favorite deals in 20 years. And I'm going to make Transplace the third, because you and I did that one. And that, frankly, was one of the biggest that I've done. But just because you and I are talking, I'll not say Transplace, even though it was a terrific deal. The first deal I did in private equity was back in 2000. I had just left the railroad, joined Fenway Partners. We were just starting. We just raised $1 billion fund, and we were just starting transportation logistics to invest about half of that. And so I didn't know much about private equity. And we ended up buying a family-owned trucking company, non-asset-based trucker. They did all owner-operators in Dallas. And it was a terrific company. It did grocery deliveries. It had been founded by K.L. Breeden, 30 years before I met him. His sons were running it. It had about 1,000 owner-operators as their trucks. And there was this retailer who had just gotten into the grocery business. They were called Walmart. And they were just starting up in the grocery business. And they basically outsourced all of their dedicated grocery deliveries to the company at the time that was called Transport Industries, but K.L. Breeden. It was little backwater business. Met the family, loved them. We spent time negotiating, bought it. As I said, it had about maybe 1,000 trucks. And I went in as CEO after about 6 months, kind of half time, because I was still building the private equity business. And we started growing that business. We got lots of new customers. We had Kroger and Safeway and Albertsons and Super Value. And we ended up 5 years later, I had brought in another CEO. We ended up 5 years later having bought a company that had about a little over 100 million in revenue. And then 5 years later, we sold it when it was at about 1.2 billion in revenue. And again, I'd been the CEO, buying companies, growing it, out with customers, kind of half time. Talk about being on the road. And we added brokerage. We had a little bit of warehousing, and so that was a fun one, George. I think part of it was the time. It was my first deal. It was one I could jump in with both feet. It had these terrific. The sons of the founder stayed involved. We kind of acted as vice chairman and kind of shepherded along. And in hindsight, it's fine. I don't mind saying, they taught me the business and shepherded me along. And the whole thing was terrific. We had a really good exit and outcome. And that was a really highlight type investment. Another one that's just been terrific is one we still own right now. It's a freight forwarding company called Seco. And it's got another element that I really enjoy and I've always liked, which is international. I have always been very interested in international back to my McKinsey days. And this company has big operations in Asia, especially in China and Hong Kong, big operations in Europe. So I've been in Europe and Asia multiple times. With this is kind of always the base that I go for. And then I can be looking for deals, looking for buyers there. The growth has been just terrific. One of the employees in Seco, when we bought it, was running Asia. He had lived in China. He's American, graduated from Kingsport, the Merchant Marine Academy. And he'd been in China for 20 years, spoke fluent Mandarin, had a Chinese wife and family. And so the CEO, when we bought the company, was ready to retire. That was part of the reason for selling. And so we plucked James Gagne, James, out of China, brought him back to the U.S. He was a little wary. His wife had never lived in the U.S. And again, that company has more than tripled in the well, not even 5 years that we've owned it. And so I've been very active in that to work closely with the management team. And so those are examples of what you get to do in private equity. You've got that variety. McKinsey was great because McKinsey had a lot of variety, the consulting and again, a lot of travel that I kind of like, but it's not like really having full responsibility for the company, it being an owner, being a lot of times chairman of the board and working closely. So that's what private equity's allowed me to do. And I've got terrific partners now. And then I do look at Transplace, George, which if you think about the growth path we had there, that was just what tremendous fun. Great management team, huge transition, very explicit kind of that company grew because of what the management team did, not luck, not e-commerce picking up immediately and they just happened to be in it or whatever. That was, as you remember, hard work with the right management team using our capital. And, the company, well, again, I think close to more than tripled, right? Over we owned, well over doubled while we owned it. So there's some examples, and that's what keeps me energized as I'm getting gray.
Well, unfortunately, the countdown clock's gone red on me, so I'm going to have to say goodbye to my friend John Anderson. John, thank you for doing this. The enthusiasm fills the room, it fills the screen. Thanks for doing this. Stay healthy, stay safe, travel safely on the way down to Florida, and I'm sure we'll talk really soon. And promise me that. We'll do this on a decent cycle. Like once every 6 months, we'll get an update. We'll get an update for you, okay?
To connect back up with you, having been away for a couple of years now, that's always a pleasure, George. So I really appreciate it. Thanks so much.
Thank you, John. Be well. And thanks, everybody. This was Supply Chain Spotlight. Thank you.